Good afternoon, everyone. Welcome and thank you for joining us today for key takeaways and updates for healthcare organizations. Well, we finally had a sunny morning here in New England, at least, but I know the clouds are moving in and we have that dreaded rain coming, so another typical day here in New England in April. First and foremost, all of us want to wish and hope that everyone is healthy and safe during these challenging and extremely interesting times. Please stay strong and keep doing the goodwill and service that you've been doing all along. There's going to be some light at the end of the tunnel, and we'll hopefully all have a nice celebration then. My name is Michael Criscione. I'm a partner and co-leader of the firm's healthcare practice group, focusing on post-acute providers. We have some great presenters here today that have devoted a significant amount of time and energy uncovering opportunities for healthcare organizations and providing hopefully some updates as soon as last night that information came out. As you know, as you dig through and read through all this information, it becomes clear that it's clear as mud. So we will try to help you as much as we can, but keep in mind that things keep changing and will change day after day, week after week. So with that, we have a number of presenters here today, Kate Broderick, Mitzi Hollenbeck, and Ron Heck. Each will introduce themselves during their section. So with that, I'm gonna start off and kick it off. So we'll move forward onto the next slide. So first, we'd like to talk about some funding that's available as a healthcare provider. As you know, the CARES Act covers a lot of information. And on top of that, there's a lot of information that's applicable to healthcare providers. One of the items that did come out, it's probably been a couple of weeks now, is the Medicare advance payment. As it says, it's an advance payment. It is not funding, it is not a grant. It is actually a mechanism for cash flow. So what the basics are for this is that you're able to ask for, without any significant process, 3 months of cash flow equivalent to roughly what you've been 3 months of billing for 2019. You're able to then hold on to this money and not stop paying back any money until after month 4. And then you'll have 3 months to pay back the money and take you up to 210 days or 7 months. The positive with this is that it is cash flow right now that you can use, especially if you haven't got a PPP loan yet or it hasn't come through. So this is money that can help you with ongoing expenses. And as you know, the challenges that you're running in your facilities is that you're paying more and have to pay more for your staff and for costs. So any additional cash flow is helpful. I guess the negative end is that you want to make sure that when the 4 months comes up that you're going to be able to pay back the money. And hopefully if you do have a PPP loan or other mechanisms, you'll have the cash flow. So it's really just something hopefully that you can think about taking advantage of now and worry about it later. All right, can we go on to the next slide? So here's just a visual of what we have laid out. So basically, as I said, the money will come in now and you'll have 180 days and then you'll start recouping. So I think it's something to keep an eye on. If you're going to do it, it's still available. I know many providers have asked for it, and it's just something, as we talk about at the end, you want to make sure that you have the ability to pay it back. And hopefully with all the other funding you're receiving, this should be all set. Okay. So the big thing we want to talk about is obviously the Provider Relief Fund, federal stimulus, however we want to call it. This was the money that came out, and there was talk that it was going to be to hospitals, and all of a sudden everybody found a nice chunk of change in their bank account last week. So this is the $100 billion Provider Relief Fund, the federal stimulus fund that you're hearing about. And last week, 30 billion of that 100 billion was released, and it was released to all Medicare providers using a formula which roughly equated to about 6.2% of your average billing in 2019. So it comes across and everything is labeled grant funding. But there are terms and conditions that you need to read and specifically certify to that how you're going to use the money. And as you can see on the slide on the second bullet, the big items there are to prevent, prepare for, and respond to COVID. So you want to make sure that you're abiding by those three big words when you're looking at these dollars. Okay, so now what's happened since then? Well, the update is that there's another $20 billion that's going to be coming out to Medicare providers also, but that money is going to be based on your 2018 cost report. So, and that money should be coming out starting next week. So again, there's going to be a tranche of money that's coming out that you're going to have to certify. And then that tranche is going to also ask you to certify to make sure that the dollars that you received are correct. So not only will you have to certify, but you're going to have to certify the revenue numbers that we use to calculate it. And again, it's similar to the $30 billion that you received, that you're going to have to make sure that you can show that you spent it for healthcare expenses relating to prevent, prepare, respond. Just keep remembering those three words, and lost revenue. Next slide. So here are some information that you might want to ask. As I said, I've been trying to cover them in this slide, but they're just a couple of questions and just some answers that you might have on this. So I think the big thing, as we mentioned, is to just go back and look at the terms and conditions that to go with this. Now, some of the breaking news on all this is that not only that you're going to get another $20 billion is going to be allocated, there is going to be a tranche of money, dollars have not been determined, that are going to go toward Medicaid or Medicaid-only providers. Now, it says Medicaid-only providers, but there was also wording that there was going to go to high-volume Medicaid providers. And they used the quote, skilled nursing homes. So I would anticipate that there will be a third batch of dollars coming in sometime down the road to those providers, specifically nursing homes that have a high Medicaid census. What that's going to be and how it's going to be calculated, nothing has been released yet. But just wanted to let you know that there's going to be some additional funding coming down the road. Again, probably all tied back to that certification that you read with those three words: prevent, respond to, and prepare. So with that, I would just keep moving on and just think about how you're going to be using that in the future. Next slide. So here's just, again, a quick summary of who's eligible, the requirements. We tried to recap a lot of them here, but again, I would definitely read the terms and conditions and talk to others, accountants, professionals, your lawyer, to make sure that you're definitely adhering to these funds. They want everybody to be able to use these funds, but obviously if there's going to be some way that you're not ever going to touch these funds, they do want the money back. So we just want to make sure that everybody understands that this exists, and that hopefully there's no strings attached, but there's some strings attached. If you can understand that, it's the government. Okay, thanks. Move to the next slide. So the other item I wanted to bring up is FEMA. Other people have been asking, what other types of vehicles are out there that are for healthcare providers, especially if they weren't eligible in round one or even maybe round two of any PPP loans and assistance. So this is out there for not-for-profit. So again, you have to be a nonprofit to be eligible for this. The terms, the information we have is very sketchy right now. We do know that you got to go through your state FEMA agency. They are taking applications and setting you up in their portal system. But just some takeaways that I just want to let you know is that this probably is something that should be one of your last resorts for funding. Most likely, it's not going to be money that's going to come out in the near term. It's probably something that's going to happen toward the end of this whole crisis. So if there's other avenues, through the PPP loans or other federal stimulus money that you can use those funds, I would go to them. But this is available for nonprofits. It's just something probably that's not going to be something that you're going to see dollars for now. It's probably more down the road. But again, there's more information is coming out on this and will come out, but I wanted to let everybody know that they are eligible if they meet the criteria, and it's there for them. All right, Kate, take it away.
Thanks, Michael. So I'm going to spend some time going over the changes to regulation and reimbursement as it pertains to the CARES Act, as well as the implementation of some of those changes by CMS. And we're also going to spend some time talking about telehealth and what might be available to you all in terms of supporting more robust telehealth expansion. So these are kind of the general provisions. None of them are probably much of a surprise at this point. Testing is required to be covered under the CARES Act, as well as preventative services. One thing to note here, this is any item or service meant to mitigate or immunize against the virus. The language around mitigate and immunize has not been, immunize fairly straightforward, mitigate less so. And thus far, we have not seen any additional guidance on the definition of mitigate. Vaccine cost sharing has been eliminated. Hopefully that's a problem we get to deal with sooner rather than later. The Medicare sequester suspension. So the Medicare sequester that went into place in 2013 that reduced Medicare payments by 2%, that will be suspended beginning May 1st through the end of the year. So any Medicare reimbursement you receive, you should see a small boost there. The FMAP increase. So as part of the CARES Act, there was an increase in the federal matching percentage for Medicaid. Thus far, a few states in the Northeast have worked to pass that increase through to providers. Rhode Island and Connecticut have passed temporary increases to Medicaid providers of 10% for the months April through June 2020. It's unclear, whether that might be extended or what the long-term implications of that might be. But there is some additional funding available through Medicare, depending on how your state is managing the increase provided by the CARES Act. So these are a few kind of key provisions for post-acute care providers. The CARES Act has waived the 3-hour rule for inpatient rehab facilities. They've waived the site neutrality rules for LTACs. They've suspended the 50% rule for LTACs as well. They have extended the Medicaid money follows the person demonstration and extended $75 million in funding through November 30th of this year. And then CMS has issued a number of waivers that will have implications for post-acute care providers. So the 3-day hospital stay requirement for SNF coverage has been waived. CMS has also authorized renewed SNF coverage without having to start a new benefit period. That's for some beneficiaries, not all. CMS is allowing non-SNF buildings to be temporarily certified in order to support isolation protocols. They're also allowing rooms in long-term care facilities that are not typically used for patients, activity rooms, something like that, to be used to accommodate beds and residents, so long as it's safe and the patients are comfortable. CMS is also waiving requirements for physician and non-physician providers to perform in-person visits. These can be conducted via telehealth as appropriate. They're also permitting physicians to delegate a broader scope of tasks to appropriate providers at SNFs. That, again, is just a high-level overview. There are a number of waivers available through CMS. There are additional waivers pertaining to managing transfers and patient groupings, as well as waivers pertaining to some relaxed requirements around reporting and data submission. An additional waiver for LTACs, CMS has issued a blanket waiver to exclude patient stays where an LTAC admits or discharges the patient in order to meet the demands of the public health emergency from the 25-day average length of stay requirement. This will apply during the waiver facilities, also to facilities that, during the waiver period, to facilities that are currently seeking LTAC classification. And then the final piece covered in the CARES Act of note, there was a $200 million appropriation to CMS in the CARES Act, $100 million of which was earmarked for nursing home facilities in order to support the necessary expenses of survey and certification programs. Details on this have not been released. From the guidance we have seen, it appears that this money may go towards things like supporting infection control, but we have not seen anything thus far around kind of an avenue to apply for or receive that money. Telehealth. So a number of changes have been made regarding regulations for telehealth. Some of them will be applicable to post-acute care, some of them less so. One key one to be aware of is the relaxed enforcement of certain aspects of HIPAA. So the Office of Civil Rights will be allowing providers to use kind of commercially available services like FaceTime, Skype, Zoom to communicate with patients via personal devices. That's something that was not allowed previously. Providers have to act in good faith and do their utmost to protect PHI, but this should provide an avenue for facilities or providers who did not previously have a HIPAA-compliant telehealth platform to stand up some telehealth capabilities in relatively short order. In terms of licensing, CMS is allowing providers to practice across state lines so long as they have an equivalent license in another state. One thing to be aware of here, state and local laws do still apply. So this is an issue that, if you've got a provider who's residing outside the state, maybe, they live in Connecticut but practice in New York, be sure to check with your counsel to ensure that there are no violations there. Another thing to be aware of here, therapists, physical occupational speech therapists are not considered telehealth providers. So they're able to do e-visits. They're not able to establish new patients. CMS has indicated that they are aware of how limiting the telehealth provisions for these therapies are, and they are working to leverage the statutory flexibilities through the CARES Act to provide more remote services for therapy needs. So hopefully something around that will be forthcoming. Another handful of key things to be aware of. Medicare has expanded flexibility around telehealth, eliminating the need for a patient to be seen within the past 3 years. They're also permitting audio-only visits, and those audio-only visits fall under the existing audio-only codes that previously were not reimbursed. Providers can use telehealth for visits with chronic kidney disease patients who are on home dialysis. They can use telehealth to recertify patients for hospice. And the Department of Health and Human Services has been kind of issued the responsibility of offering clarifying guidance on the use of telecommunication systems for home care. CMS has issued a variety of relaxed regulations around home care. We have not seen anything specific from the larger HHS group, but that hopefully will be forthcoming as well. Some key reimbursement changes, I'll just call out a few of these. Cost sharing, healthcare providers under Medicare have the opportunity to waive coinsurance and deductible requirements. Setting flexibility, so the objective here is for all settings and the care that's permitted under telehealth to be provided from anywhere to anyone. So it's eliminated the originating and distant site requirements, which could be helpful depending on if you've got providers that are perhaps stuck at home or something like that. CMS has also decided to reimburse for telehealth visits at the same rate as face-to-face visits. So some telehealth opportunities for post-acute. CMS has expanded the list of codes that it'll be reimbursing under telehealth. I think it's about 80 codes, 85 codes. Taken in conjunction with the waivers CMS has issued that's offered additional flexibility. There is a lot of opportunity to leverage telehealth in order to meet patient needs and reduce the exposure both on the provider side and the patient side. So ED visits, as an example, can be conducted via telehealth. Evaluation and management visits can be conducted via telehealth, as well as getting specialty support, for example, wound care specialties, being able to bring those into the nursing setting without actually having to bring the provider in. Another opportunity to consider are remote patient monitoring opportunities, whether that's kind of quote unquote store and forward consultations where you might be using imaging of wounds or incisions and communicating with providers that way, also digital vital monitoring. So there are a variety of different avenues to implement telehealth, as well as, fortunately, a program through the FCC that will support the kind of purchase and implementation of some of these programs. Unfortunately, this is limited to nonprofits as well. However, if you are a nonprofit, they do specifically call out skilled nursing facilities. If you're not a nonprofit, there may be an opportunity through a consortium. So they provide for consortia of healthcare providers consisting of one or more entities falling into the allowed for categories. And so if you're not a nonprofit, but you might have an avenue to form a relationship with perhaps a nonprofit health system in your area, that could be a pathway to access this money. So this money is able to be used for the purchase of telecommunications, information services, and connected devices. And one thing to call out specifically, it is not the purpose of this money to support infrastructure that would allow for kind of manual entering of an analog glucometer reading, as an example. The idea would be for the purchase of a digital glucometer that would automatically upload readings to a portal or a medical record. So it'll provide full funding for eligible services. They do not anticipate awarding more than $1 million to a single applicant. Thus far, about $6.9 million has been distributed from this fund, and the largest gift so far has been $1 million. That went to Oxford Health System in Louisiana. Another thing to be aware of with this money, this isn't an upfront grant where you're going to get a bunch of cash. It works as a reimbursement. So really carefully tracking any costs that are accrued as part of this is absolutely critical, because you'll need to substantiate your expenses and submit them for reimbursement up to the amount of the award you received. These are going to be awarded on a rolling basis. They're going to target the hardest hit areas. They will not, however, be targeting specific conditions, patient populations, or geographic areas. Applicants should target or should document the hardships that they're experiencing, such as provider shortages that are really driving the need for telehealth within their facility or their area. And the other key pieces, devices and services funded must be integral to patient care. So this program went live April 13th. We've got a few appendix slides that have a lot more detail on what the application process looks like. So those will be available when the slides go out. But there is, this is actually one of the more straightforward funding programs that we've seen so far. So there's great information through the FCC about how you apply. There are a couple of prerequisites that have to be completed before submitting your application. But they have been rolling out, this opened up 10 days ago and they've already distributed almost $7 million. So this, if you do qualify, this could be a great opportunity to get some resources to stand up telehealth. And then this is just some programmatic considerations as you're thinking through what a telehealth implementation might look like. Understanding cybersecurity and compliance, particularly if you're looking to leverage something like FaceTime under the waivers that have been issued by CMS and HHS. Understanding what your insurance coverage looks like for providing these types of services, Another key piece that ties in with the funding mechanisms that Michael was discussing is tracking any costs and revenue associated with these programs. The guidance specific to the funding programs Michael discussed is still evolving. So making sure you're keeping careful track of things that you're standing up to combat the pandemic is critical, because you just don't know what you might be able to apply that funding for. Understanding how this is going to impact your physical footprint, if you're able to use telehealth to open up additional capacity, how you're going to, fit this into your workflow, understanding how this might impact commercial reimbursement, ensuring that your revenue cycle is up to speed for any billings you might be doing, and also making sure that you're able to provide as much privacy as possible for patients in telehealth visits. So with that, I will hand it over to Mitzi.
All right, thank you, Kate. Appreciate that. So what I'm going to talk about today is Section 1102 of the CARES program, and this is just the Paycheck Protection Program, and give you a little bit of an update as to what's going on with this program, because you may have heard quite a bit about this program on the news. Actually today, generally about an hour ago, it appears as though the House has started voting their voice vote related to the additional funding that should be coming through on the Paycheck Protection Program loan program. That program would be an additional $310 billion of funding coming into this program. The original funding for this program was $349 billion, and that particular program ended up running out of money within 20 days. So there's a lot of individuals that are out there and a lot of corporations who either had an application in, ended up being really in the queue to try to get some of this Paycheck Protection Program money, but they were cut out of the program due to its first come, first served nature in terms of the funding allowable to these businesses. So to give a little bit of an overview on the PPP program, again, this is a reminder, this is a program that is generally designed for businesses with fewer than 500 employees. This program does not require any collateral from the owners or the businesses. There's no personal guarantee related to these particular loans. And these particular loans are based upon a calculation of your maximum payroll cost in a given month. So your average monthly payroll, typically in the time period of 2019 multiplied by 2.5 gives you the maximum loan amount under this program. Then the loan proceeds really are to be used for payroll retention and employee retention during what's known as the covered period, which is the 8-week period that begins on the origination date of the loan and runs for the next 8 weeks. There's been a lot of questions and unfortunately not a lot of answers with regard to the forgiveness provisions on these loans. Under the CARES Act, it specifically stated that guidance on the forgiveness provisions of these loans should be issued within 30 days after the enactment of the act, which in this case would mean that we should see some guidance related to forgiveness starting next week. We're certainly eagerly awaiting guidance on forgiveness. What's happened since the act has been issued is that the SBA and Treasury have released 2 interim final rules, which clarified some of the provisions of the PPP program. It also generated a lot more questions on the provisions of the PPP program. And just as recently as this morning, the SBA and Treasury released another series of frequently asked questions related to this PPP program, typically in response to some of the things that you may have heard on the media with regard to some of these larger companies receiving funding under the PPP program. So there was an additional clarification related to whether there was a financial need for this program. When you apply for the PPP program, you are required to certify as the necessity of the need for these funds and that you'll use these funds to maintain levels of payroll and to retain workers. And there was a clarifying question that came out with regard to that particular necessity test that came out today. So those are things that certainly we're encouraging all of our clients and our friends to talk to their attorneys about these certifications. In the event that you haven't made the certification or it's determined that you talk to your attorney in good faith, that you have an ability to return the funds if you don't believe that you meet this criteria. So certainly that's a a brand new iteration that's come out on these loans that came out within the past 5 hours. So it's something to keep in mind. These programs are constantly evolving. Typically, with regard to these PPP loans, the interest rate on any non-forgiven portions of these loans is 1%, and the maturity date of these loans is 2 years from the date of the loan origination date. There are no payments that are due on these loans for the first 6 months, and it's actually administered and it's applied for through the local banking institutions. With regard to the loan forgiveness, as I mentioned, we're still awaiting final guidance with regard to what qualifies for loan forgiveness, but for the most part, as long as you're paying covered expenses during the covered period for payroll, certain utilities costs, interest on mortgages, and rent payments, that as long as you've paid 75% of those loan proceeds are for payroll, if you've maintained your full-time equivalent headcount, then you will typically be able to apply for some measure of forgiveness on these loans. We mentioned previously, there's no personal guarantee, there's no collateral, and it specifically claims within the Act that any loan forgiveness amounts will not be included in the business's taxable income. There are rehire provisions related to if you have laid off some of your employees and you're calculating essentially your base number of full-time equivalents versus your full-time equivalents during this covered period, this 8-week period once you receive your loan, and you've had a reduction in the headcount, provided that you've returned that headcount back to your kind of your base level of full-time equivalents, that there's some measure for a rehire provision that will not reduce the amount of forgiveness. Guidance specific to those provisions and those dates, we expect to be coming out hopefully next week. So we'll move on to the next program, which is the Economic Injury Disaster Loan Program. And similar to the PPP program, this program also ran out of money in a very short period of time. The expansion of the CARES Bill Act that's being voted on by the House today, previously passed by the Senate, will also provide additional funding to the EIDL program through the SBA. And so this particular program itself is really designed for qualified small businesses, again, as defined by the SBA, which typically these businesses are going to be fewer than 500 employees. In this case, they also may have revenue standards and other size standards because it goes under the SBA's size standards and determination, as well as any sort of affiliations that you may need to consider with regard to eligibility for these loans. But these loans provide proceeds up to $2 million, typically for working capital funding. The PPP program is typically designed to allow for payroll to continue and to continue to pay your workers. The EIDL program is typically used for working capital purposes to keep your business going. You also need to make sure that you demonstrate that you have an economic injury with regard to this particular application. There are provisions for collateral provisions and personal guarantees. There's also a requirement for any loans over $500,000 need to have a real estate guarantee associated with them as well. The proceeds can be used, as I mentioned, for working capital. They can be used for payroll, AP, inventory, equipment. You can't necessarily use the same, you can't use proceeds from the EIDL program and the PPP program for similar uses. They need to be for different uses. And this EIDL program is not eligible for loan forgiveness. The interest rate is 3.75% for for-profits. It's 2.75% for nonprofits. And borrowers can defer the principal and interest at least for the first year following the loan. This is a program that's administered through the SBA. There was an advance that also ran out of money, which is the EIDL advance grant for $10,000. Hopefully that will receive additional funding in this act, where the application you could apply for an advance up to $10,000 depending upon the number of employees that you have within your organization. So there are some areas where the EIDL loan and the PPP loan do cross over, and it's really related to the advance grant and your calculation of forgiveness. So we'll jump into the third economic stimulus loan, which is on the next slide. And this is really the Main Street lending program. So there's an additional lending program that's going to be administered through the Federal Reserve, which is going to allow for up to $600 billion in new financing for eligible borrowers. So these particular loans are really geared at the next tiered size up of a company. It needs to be fewer than 10,000 employees, and you need to have less than $2.5 billion in revenue. in order to apply and be eligible for these programs. There's both new loans and there's expanded loans, although they typically have roughly the same terminology associated with them in the same terms. These are 4-year loans. There are repayment terms which allow for a 1-year deferral of principal and interest payments. There's no prepayment penalty. The minimum loan size under this program is $1 million, and the maximum loan size is based upon a calculation based upon EBITDA and the company's EBITDA, as well as some of their undrawn debt. So you pretty much are taking a ratio, a debt to equity ratio, and an ability to repay these loans and calculating what your maximum loan size has to be. There are some issues. You can't participate in, although they're pretty much the same thing. There's the expanded loan program and the new loan program. You can't participate in both at the same time. There's also a primary market corporate credit facility allowed in the CARES Act. You can't participate in these Main Street loan programs plus that primary market corporate credit facility, but you can participate in the PPP and the Main Street lending program. So there are fees associated with regard to these programs. Let's go to the next slide. And there are attestations. These are, this is probably the crux of this particular loan program. If you sign up for one of these loan programs through the Federal Reserve, you will have limitations not only through the time period by which you have this loan, but 12 months following the payment or the repayment of this loan related to certain attestations, stock compensation limits, you have dividend limits, you have distribution limits associated with it, and you also need to make sure that you're not going to be using these funds to repay other loan balances that you have outstanding. So these loans are available, as I mentioned, typically for slightly larger businesses. The program guidelines related to these Main Street loans have not been issued yet, but we certainly will be looking for these and updating you with regard to any information we have on these programs. And with that, I'm going to turn this over to Ron.
Thank you, Mitzi. I am Ron Hecht. I am a tax partner in the Citron Cooperman's White Plains, New York office. And it's an unusual situation as a presenter of tax provisions to say, I think I'm presenting the easier provisions for the day. The one thing I would like to add related to the PPP loans is there is a provision in the CARES Act that provides that any forgiveness, even though it's any forgiveness of loan, even though under general tax rules would be treated as a taxable cancellation of indebtedness, the CARES Act provisions provide that that forgiveness will not be subject to taxation. The question that we do not have an answer to, and maybe we will see it when we see forgiveness rules in the next week or so, is a question of whether money that is attributable to forgiven debt, if the expenses paid with that money would be tax deductible expenses. We're not sure. We're hoping, based on other things we've read, that they will be, but again, we are not 100% sure. And if we could go on to the next slide, talk about some of the tax changes that were in the CARES Act and were designed to help drive tax benefits, tax deferrals, tax refunds to entities and individuals affected either directly by COVID-19 or indirectly through some of the stay-in-place rules that we are all literally living with. The first provision, which is Section 2301 of the CARES Act, is designed to provide a credit to employers, and the rules are different whether the employer is 100 employees or more or less than 100 employees. For employers with less than 100 employees, this credit, which is 50% of the first $10,000 of eligible compensation to each employee, or a $5,000 credit is available to employers whose operations were fully or partially suspended due to a COVID-19 related shutdown, or their gross receipts declined on a quarterly basis by more than 50% when compared to the same quarter in the prior year. If your organization has greater than 100 full-time employees, the qualified wages are strictly wages paid to employees that are not providing services due to COVID-19 related circumstances. The credit mechanism works through a credit against the employer's payroll taxes. And what will happen is for each $5,000 credit that you're entitled to, the quarterly 941, which is being redesigned, is going to have a provision for crediting the employer with this $5,000 credit if your payroll taxes are less than the amount of the credit that you would be entitled to under these circumstances. There are provisions to apply for an immediate refund of the excess credits. The credit is available for wages that are either paid or incurred from March 13th of 2020 through the end of the year. The next provision, which is a delay of payment of certain employer payroll taxes, is available to employers of all sizes, and the credit is allowed for the employer that has payroll taxes incurred. Interesting that these two provisions, while enacted in the same law, have different coverage dates, but the deferral of employer payroll taxes in this provision covers wages, covers payroll taxes attributable to wages paid or incurred between March 27th, 2020 and the end of calendar year 2020. The covered taxes that can be deferred are strictly the employer's portion of the Social Security tax. Any amounts that are deferred during this eligible period would be payable without interest or penalties, 50% at the December 31, 2021, and 50% at the end of at December 31, 2022. So for wages that are being paid during this second quarter of 2020, we are really looking at a deferral of payment of the payroll taxes for a year and a half for some of the taxes and 2.5 years for the balance of them. In addition, if we're dealing with self-employed individuals, the self-employed individual is entitled on their own tax return for a deferral of 50% of the payroll taxes, or the 50% of the Social Security taxes through self-employment tax that are attributable to their self-employment earnings that run for this same March 27th through December 31st period. Now, one caveat to this is that if you are an employer who has applied for a PPP loan and the 8-week period of your loan since you've received the funds has passed, and you've now applied for and received a deferral, received a forgiveness, on the day that the bank authorizes the forgiveness, you no longer are eligible to include payroll taxes in this deferral computation. And just to be clear, it's a cutoff of wages going forward. Any wages that were eligible for this deferral up to that period of the forgiveness grant would continue to be eligible for the deferral. Next slide, please. These provisions relate to changes in the tax law designed to either change existing provisions or reinstate certain provisions that were enacted in the Tax Reform Act of 2017 that law, the first provision, the 2017 Tax Act, the TCJA, specifically eliminated the ability to carry back net operating losses for years beginning after December 31, 2017. Those losses for years 2018 and forward could only be used against current year's income and be carried forward as operating loss carryovers. This provision in the CARES Act for years beginning before the year 2021, meaning the years 2018, 19, and 20, if a taxpayer incurred a net operating loss, including one in 2018 where the carryback had been suspended, would be allowed to carry back losses for a 5-year period to potentially get a refund of taxes paid during that 5-year period. The losses would have to be carried back to the earliest period in the 5-year period. Any losses that would be unused in that 5-year back period would go to 4, 3, 2, and 1 year back, and then would be continued to be carried forward. If it's determined in looking at these on a planning perspective that these losses are more valuable on a carry forward basis, there are newly designed provisions that would allow the waiver of the use of these carrybacks on the 2020 income tax return. The next provision, also out of the Tax Cut and Jobs Act of 2017, was a limit on the amount that an individual could use on their personal tax return for the deduction of what's called excess business losses. The loss limitation was $250,000 per individual, so a couple filing a joint return would be limited to $500,000 of excess business losses in their 2018, 19, and going forward tax returns. The law has been changed retroactively to allow full use of these losses if they are otherwise eligible to be deducted as business losses. So again, it's an opportunity to take a look at 2018 returns that were filed, or potentially 2019 returns that were already filed, to see if there are amended return possibilities to claim additional refunds. These losses, once created, if they result in a net operating loss, would be combined with the net operating losses that I mentioned previously. The next area to go through quickly so that we can get to the last one that is applicable to a lot of taxpayers is if a business loss, if a business, either a flow-through loss or an individual with their own business, had limited amounts of taxable income in 2018 and 19, there was a limitation on the deductibility of their business interest based on 30% of their adjusted taxable income from the business. The provisions of the CARES Act change these rules to change the 30% number to a 50% number, allowing a mechanism for potential deduction of additional business interest expense. The last provision in the business tax area that was a change to the TCJA as well, was a correction of an error in the drafting of the 2017 tax law. Prior to 2018, the law provided that qualified improvements, primarily qualified leasehold improvements, were eligible property to be treated as 15-year depreciable property, which in many cases allowed for either, depending on the timing, either a 50% or a 100% bonus depreciation deduction in the year that the property was placed in service. a drafting error in the 2017 tax law changed the depreciable life of qualified improvement property from 15-year to 39-year. And by changing it to 39-year property, it no longer became eligible for the immediate deduction as bonus depreciation. The CARES Act retroactively corrected these drafting errors to allow qualified improvement property placed in service during calendar years 2018 and 2019 to be changed to 15-year property, which potentially made them eligible for immediate write-off. Now, there are a number of ways that this can be accomplished. I will leave it that it is something best looked at in combination with other changes in the law, the net operating loss provisions. This will change taxable income. It can be done either in amending of a 2018 return and amending of a 2019 return, or the possibility of waiting for 2020 and taking the cumulative effect of this change for the 3 years as what is referred to as a change in accounting adjustment. That's the high-level look at what this provision is. If any of these provisions potentially result in additional deductions and losses, the obvious advice is clearly to reach out to your accountant. That could be helpful in determining the best way to approach these provisions. I will now turn this back to Mike for questions and answers that may have come up.
Thanks, Ron. Well, there's a lot of stuff going on. So we do have a few questions. And again, if you have any other questions, please submit them and hopefully we can get them in. Mitzi, we have a question. Can you maybe get back to some of the discussion regarding the additional funding that we heard you talk about that the Senate passed, but the House is now voting on, and how that is, how that might be the same or different than what went through in the first round?
Yeah, so what the House is voting on right now is really just an expansion of the CARES Act, meaning instead of it being a separate act that's going to be subject to a number of different rules and regulations with regard to that PPP money or the EIDL money getting out to those small businesses, this will just be an expansion of the existing program itself. So there's $310 billion that's been set aside in this particular text. The only difference really is that 60 billion of the $310 billion is really designed to be guaranteed to go to smaller lenders, such that those lenders who are typically community lenders are able to get that money into the hands of what are truly determined to be small businesses. There was a lot of kind of public outcry, as I had mentioned earlier, related to some of these larger businesses getting the majority of these loans. And so they're not entirely sure how this is going to actually play out, though. So be wary about this in the fact that, if again, some smaller lenders or, lenders that typically, credit unions and community lenders who are going to have $60 billion at their disposal to be able to submit loans through up to SBA. We don't know right now if they're going to have a separate portal, if that process will be any different than what exists now, because they're not traditional SBA lenders. So they're going to need to get up to speed on the $60 billion of this act to be able to deploy that money into our small businesses. So that's really the only difference that exists right now, is that there is this set aside that's designed to try to alleviate the issue and disparity for these larger businesses who are applying for these loans.
Thanks, Mitzi. Kate, could you maybe elaborate and maybe just talk about how someone might get into the telehealth, or they might look into seeing what they can do at their facility? Since telehealth has been around, but for many, this is either brand new or something they're even just starting to think about. So I don't know if you have any initial thoughts. I know there's a lot to cover, but is there any best practices you can suggest to the group, to the audience?
Sure. So for organizations that previously had not dipped their toe into telehealth, which, given the regulations that applied to telehealth previously and the relatively low reimbursement, there wasn't a ton of incentive to invest much in standing up a new program. But with the flexibilities that have been afforded under the CARES Act and the public health emergency, it's a great time to take advantage of those flexibilities to test some telehealth capabilities. So the first thing that any organization who hasn't previously done this would want to look into is their state and local regulations. So laws and regulations that apply outside of the relaxed rules that have come down from the federal government. And kind of along with that, understanding your insurance coverage. Getting those two things into place will be critical before making any major decisions about how you want to move forward. And then from there, again, if you haven't done anything with telehealth previously, it could be a major change for your staff and just a different workflow, a different way of interacting with providers and patients. So picking a couple use cases to test and pilot a telehealth program is a great way to get started. Again, the flexibility afforded under the Office of Civil Rights will allow you to use technology that you probably already have available to you today on your phone. So it's an opportunity to identify a couple use cases, test it with some of your providers and patients who might be more willing to try something new, and begin understanding what works for you, what doesn't work for you, what potential a future path forward might look like, and then from there begin kind of plotting out the best avenue for you to take advantage of the flexibilities as they exist today. And then, as you look towards the future, a lot of these flexibilities, some will stay, a lot will probably go. So as you adapt telehealth to your care delivery model, understanding what you need to do on a go-forward basis in terms of standing up a platform that is HIPAA compliant, understanding the cost structure around it, doing some financial modeling to understand what the long-term implications will be.
Well, thank you. I know there's a lot. I asked you to keep it brief, and I know you could talk on this, and you have for much longer. So if anybody does have further questions, I would be happy if they can reach out to you. I think we have one more question we can probably squeeze in, and it relates to the provider relief fund. So yes, there is a certification that is required. They've given you 30 days after the receipt of the money to actually certify, but there is a caveat that if you don't actually certify, then there's going to be a presumption that you did want the money and that you'll be entitled to the money and that you'll be using the money as intended, and you'll have to follow the guidelines if you had certified. And those guidelines are, if it's greater than $150,000, you'll need to do a quarterly reporting. If it's less than 150, you'll have until the end of the year. What that reporting is going to look like, we have not been provided that. So again, I would make sure that you do follow up. There should have been a follow-up email regarding the provider relief funds that you can click on and get to a portal and you can certify. So if you don't certify, they're going to assume that you do, and they'll just assume you want the money. So with that, it is right at 3 o'clock. So again, thank you for joining us here today. And if you do have any questions, the names of the contact people that spoke today will be on the slides that will be forthcoming, or just contact your Citron-Cooperman representative that you deal with, and we'll be happy to answer any of these questions or any other questions that come about. So with that, and on behalf of all that spoke today, we wish you a good day. Stay safe and happy, and be well, everyone. Take care. Bye.